Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Gemini Space Station Inc. Annual Report. Gemini Space Station Inc. offers a wide range of businesses and services to cater to the growing demand for cryptocurrency and blockchain technology. At its core, the company provides a platform for buying, selling, and storing various crypto assets, including Bitcoin and Ether. In addition to this primary function, Gemini also offers several advanced services that set it apart from other players in the industry. These include a derivatives exchange, which allows users to trade cryptocurrency-based contracts, staking services where users can earn rewards by holding certain cryptocurrencies, an over-the-counter trading desk for large-scale transactions, and institutional-grade custody, providing secure storage solutions for institutional investors. Gemini also ventures into new areas with its innovative products. The company issues a stablecoin, which is pegged to the value of the US dollar, offering a more stable alternative to traditional fiat currencies. Furthermore, Gemini has launched a US credit card that rewards users with cryptocurrency, making it easier for individuals to integrate crypto into their daily lives. The company's Web3 studio focuses on non-fungible tokens, NFTs, allowing artists and creators to mint and sell unique digital assets. This service is part of Gemini's broader mission to build a more inclusive and accessible blockchain ecosystem. Overall, Gemini Space Station Inc.'s diverse range of businesses and services positions it as a leading player in the cryptocurrency industry, catering to both individual retail users and institutional investors alike. Gemini Space Station Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Gemini Space Station Inc. trades at a lower price-to-book ratio of 0.93 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for various companies in the crypto industry can be categorized into several key areas. Transaction fees on trading of crypto assets are a major source of revenue for many companies, including Voyager. Volatility in crypto asset prices and limited history of crypto assets also play a significant role in valuation and revenue. Customer behavior, such as customer trading volume processed over the previous 30-day period, is another important driver of transaction revenue. Additionally, market conditions like global supply and demand, competition from other forms of cryptocurrency, and credit card activity can impact revenue. Revenue growth can also be driven by specific business models, including NFT sales, staking revenue, custodial fee revenue, and advisory fee revenue. For instance, companies like Coinbase are impacted by volatility in crypto asset prices and limited history of crypto assets. In contrast, companies like WCF experience related party revenue growth due to their unique business model. Ultimately, the primary drivers of revenue growth or decline for these companies are closely tied to their business models, market conditions, and customer behavior. Understanding these factors is crucial for investors and analysts seeking to assess the financial performance of these companies. The net income of the company experienced a decline between 2023 and 2024, with further deterioration in 2025. In fact, the company incurred a significant net loss of $582.8 million in 2025, which is a substantial increase from the previous year's net loss of $158.5 million. This downward trend in net income suggests that the company faced severe financial challenges during this period. The profit margins also underwent a transformation during these years. Although not explicitly stated for 2023, it can be inferred that the company had negative profit margins due to its net losses. However, there was some improvement in 2024 with an adjusted EBITDA margin of -0.08%. The most notable change occurred in 2025 when the adjusted EBITDA margin increased to a positive 0.04%, indicating a slight recovery in profitability. The decline in net income and the initial negative profit margins can be attributed to various factors, including operational inefficiencies, market fluctuations, or strategic decisions made by the company's management. The improvement in profit margins in 2025 may suggest that the company has implemented corrective measures or adapted to changing market conditions, leading to a slight increase in profitability. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. In 2025, the company achieved positive operating cash flow, marking a notable shift from previous years. This achievement is reflected in the substantial increase in net cash and cash equivalents, which reached $247,990. This positive trend suggests that the company's operational efficiency has improved, enabling it to generate sufficient cash to cover its expenses and invest in growth initiatives. The generation of positive operating cash flow is a crucial indicator of a company's financial health, as it demonstrates its ability to sustain itself without relying on external funding sources. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, the total indebtedness as of December 31, 2025 is $94,457,000, a substantial increase from previous years. The related party loans were converted into shares in 2025, eliminating this type of debt. However, the total liabilities increased to $972,187 in 2025, and the convertible notes rose from $200 million in 2024 to $230 million in 2025. The warehouse credit agreement with Ripple Labs Inc. also saw an increase in its maximum aggregate commitment amount from $150 million to $250 million. The debt level has increased significantly from 2024 to 2025, with a total debt of $219.8 million in 2025. On the other hand, interest expenses have fluctuated, but overall, they have increased. The total interest expenses rose from -$150,920 in 2024 to -$243,144 in 2025, and the interest expense on related party loans and third-party loans also saw significant increases of 24% and 28%, respectively. However, the interest expenses as of December 31, 2025 were $25.3 million, down from $30.6 million in 2024. The performance of various regions and segments in the industry has been mixed. On a positive note, the United States has seen significant growth, with resources being focused on this market. The Asia-Pacific region, despite having a smaller presence, has also performed well. In contrast, international markets have struggled, with several countries announcing plans to exit or wind down operations. This includes the UK, EU, Australia, and other European jurisdictions. The United Kingdom in particular has been identified as a poor performer, with plans to exit operations entirely. Other international markets have also seen poor performance, with many countries experiencing difficulties that have led to decisions to exit the market. Management's outlook on the company's strategy is one of growth and innovation. The company plans to continue growing through product innovation, user acquisition, and engagement, while focusing on retaining users through competitive transaction fees, seamless experience, and robust security. This growth strategy is expected to be driven by increased competition in the rapidly evolving crypto industry. In terms of regulatory compliance, management is committed to staying at the forefront of crypto policy initiatives and accelerating spend on sales and marketing to expand brand awareness and customer acquisition. However, the company also acknowledges that it is exposed to various risks, including interest rate risk, changes in digital asset prices, and potential liquidity issues if it cannot generate sufficient cash flow from operations. Despite these challenges, management believes that the company maintains sufficient liquidity to fund future purchases of credit card receivables and intends to defend matters vigorously in relation to legal and regulatory matters. Overall, the company's strategy appears to be focused on navigating the complexities of the crypto industry while driving growth and innovation. Gemini's acquisitions and divestitures. A summary: Gemini has made several strategic acquisitions to expand its business and offerings. One notable acquisition is a co-branded credit card with Ripple, launched in August 2025. Additionally, Gemini has acquired companies and technologies through Gemini Frontier Fund, LLC, and Gemini Frontier Fund Cayman, LLC. The company has also been acquiring complementary businesses and technologies to enhance its services. Furthermore, Gemini aims to acquire new retail and institutional users to increase its customer base. These acquisitions are expected to boost the company's growth and competitiveness in the market. On the other hand, Gemini has made significant divestitures to restructure its operations and focus on key markets. The company has exited the United Kingdom, European Union, Australia, and certain other international markets. This includes the wind-down of tokenized securities offered by Gemini in February 2026 as part of a broader exit from the EU market. Gemini's divestitures are aimed at streamlining its operations and allocating resources to more promising markets. The company is likely to continue making strategic acquisitions and divestitures to achieve its business objectives and stay competitive in the industry. The company's financial activities have been quite active in recent years. One notable aspect is its commitment to rewarding shareholders through dividend payments. As per the records, the company has indeed paid dividends, indicating a strong focus on shareholder value creation. In addition to paying dividends, the company has also taken steps to return value to its investors by buying back shares. This strategic move not only boosts investor confidence, but also helps in reducing the outstanding share count, thereby increasing earnings per share and potentially driving up stock prices. That concludes the financial summary for Gemini Space Station Inc. Feel free to comment below, and I will be happy to answer them when possible.